Brent just tagged 80.05, up less than 1%, and the headlines are full of peace talk optimism. But here's what nobody is seeing. The market is already pricing in a successful Iran deal that hasn't happened. The numbers don't lie. There is one danger zone and one hidden opportunity right now, and I'll show you both. Because while retail traders chase this 1-hour strong buy, the weekly chart is screaming strong sell, the daily trend is still firmly bearish, and the smart money is building the trap that will liquidate late longs. Stay to the end. I'm giving you 3 exact levels you can trade today, including a sniper entry that delivers a 3-to-1 reward ratio before the next headline hits. This is Brent crude, the geopolitical heartbeat, and right now that heartbeat is a time bomb that let's get straight to the instant market verdict. My session bias for Brent oil right now is fade the rally. We are in a powerful, ADX confirmed downtrend on the daily and weekly. This bounce you see, this little intraday move from the 77.50 region back above 80, is nothing but a mean reversion short squeeze inside a bear flag. Price is not turning bullish. It is gasping for air. I'm looking for failure at resistance, not continuation. There is one single invalidation level that flips this entire bearish structure, and I want you to write it down. Write this number down. If Brent crude closes on the daily timeframe above 83.82, the whole game changes. That's the 200-day moving average, and right now it's acting like a brick wall suspended above price. Until that level breaks and holds, the downtrend is intact. That's your line in the sand. The herd right now is piling into long positions, convinced that the Iranian media walkout reports yesterday mean the talks in Switzerland are collapsing. They see the intraday push and they think supply risk is back. But here's the micro insight. The ADX on the daily is sitting at 48.8, extreme trend strength. When a market is this stretched, counter-trend bounces are violent but short-lived, and they always get sold into. The smart money is already fading that move. Don't be the exit liquidity. Now let's go deep into the technicals, top down, from the weekly all the way to the 60-minute chart. On the weekly time frame, Brent oil is in a strong sell. We printed a massive bearish engulfing candle 3 weeks ago that broke the back of the uptrend, and ever since, every pop has been sold. The 200-week moving average is way up near 85.50, miles above current price, offering no support. Its gravitational pull is down. The weekly MACD is deeply negative, accelerating lower, and the histogram shows no sign of turning. This is not a market that wants to rally. Move to the daily. Daily trend is also strong sell. Price is trading below every major moving average I track. The MA5 just crossed below the MA10, both are sloping down, 81.78 and 84.72 respectively. The MA20 is at 89.94, the 50 at 93.52. We are so far below the mean that any bounce feels explosive, but it's really just reconnecting with short-term value before the next leg down. The 200-day moving average is the key, 83.82. This level rejected price sharply twice earlier this month, and it will do it again. It is the anchor of the bearish structure. Daily RSI is at 32.25, not yet oversold, meaning there's still room to fall. Stochastics are at 23, curling but not crossed. The MACD is at minus 5.34, deeply negative, and while it's showing a slight rounding, there is no bullish crossover. Momentum is bearish. Now the 4-hour chart, this is where the trap is set. 4H trend is neutral, and that neutrality is dangerous because it invites breakout traders. Look at the price action. We bounced from near the S1 support at 77.57 and are now testing the pivot zone around 78.81, pushing toward a 1 at 81.08. But here's what most traders miss. Look at the 4H MACD. Price has made a higher low in this bounce, but the MACD line is barely budging, creating a classic hidden bearish divergence. Buyers are exhausted. The histogram is flatlining. This is not accumulation. This is distribution before the drop. On the 4H, The CCI has crawled up to minus 111 from deeply oversold, but it's nowhere near positive territory, and the Williams percent sits at minus 82. These are levels consistent with a dead cat bounce, not a reversal. Now drop to the 60-minute, the only time frame flashing strong buy, and this is exactly why retail gets trapped. The 1H chart shows a series of higher lows since yesterday's low, and momentum oscillators are ticking up. But the RSI is only at 32. You read that right, 32 on a strong buy signal. That's a divergence within a divergence. The price is rising on fumes, with volume that's likely thinning. This is a short covering rally in a bear market, and it will run out of steam exactly at resistance. The levels are crystal clear. Support, 77.57, the S1 and recent swing low. Below that, 75.30 and then 74.06, which is the next demand zone. Resistance. The immediate fight is 81.08, R1. If the 1H strong buy pushes through that, we could see 82.32, R2, and that aligns with a cluster of broken support turned resistance. But the ultimate beast is 84.59, R3, which confluences with the 200-day. Every rally that cannot close above 83.82 is a selling opportunity. And I want you to note the ATR, over $4.30. This instrument can easily move $4 in a single session. That means your risk management must be precise, and I'll give you those exact numbers in a moment. At the 3-minute mark, here is what separates winners from losers. Oil is now moving tick for tick with implied supply disruption, but that correlation is breaking down. The S&P 500 is holding steady, yet crude is weak. That tells you this is not a risk appetite story. It's a supply-centric unwind. The geopolitical bid is being priced out, even as headlines scream uncertainty. Let's connect the last 24 hours of news directly to price action. US-Iran talks in Switzerland continue, but Iranian media reported a walkout, then later backed off. The market initially dipped on the walkout rumor, then squeezed back up when talks resumed. The analyst sentiment is clear. The Brent crude rebound shows peace talks have not removed supply risk. And that's exactly why you're seeing this bounce. The market is keeping a small supply disruption premium embedded. But here is the thread you need to pull. If a deal is actually reached, that premium evaporates instantly, and we see a freefall towards 75 and below. If talks collapse completely, you might get a spike to 84, but that spike will be sold into violently because the macro picture, slowing demand, rising recession odds, caps the upside. The 1 to 2 week directional lean is bearish. I expect a retest of 77.57, and if that breaks, 74.06 comes into play. The invalidation, again, is a daily close above 83.82. That would signal a structural shift, but right now, the path of least resistance is down. Now I need you to interact with me right here. Do you think Brent breaks 77.57 this week? Comment yes or no right now. I'm tracking Consensus Live, and I'll tell you why the number of yes or no comments matters in tomorrow's video. Most people skip this next section. That's exactly where the money is made. Keep watching, because I'm about to give you 3 trade setups with exact entries, stops, and targets, and the on-screen plan you can screenshot. Strategy 1, I call the sniper, the conservative play. This is the high probability, wait for confirmation setup that aligns with the dominant daily and weekly trends. You do not chase this bounce. You wait for price to reach the 81.08 resistance and reject it. The trigger condition is a 4-hour candle close below 81.08 after a test, ideally with a bearish pin bar or engulfing candle. Once that close prints, you enter short at market on the next candle open. Your stop loss goes above the high of that rejection candle, but we give it breathing room above it too. Place it at 82.55, just above the 82.32 resistance cluster, because a break above that would invalidate the immediate bearish pressure. Target 1 is 78.81, the pivot point. Target 2 is 77.57, the key support. This gives you a risk-reward ratio of approximately 1 minute and 3.1 second. This setup is void if price breaks and holds above 82.32 on a 4-hour closing basis. If that happens, the structure has shifted short-term and you stand aside. Now, keep your eyes on the screen. Here comes the on-screen graphic for the sniper. The sniper, conservative, entry. Short on 4H close below 81.08 stop loss. 82.55 take profit 1. 78.81 take profit 2. 77.57 risk, reward. 1:3.1 hour invalidation. Void if 4H candle closes above 82.32. Strategy 2 is the active trader. The standard play for those who want to ride the intraday momentum fade without waiting for a perfect 4H close. Right now, the 60-minute strong buy is pushing price into the 80.50 to 80.80 zone, which is a resistance area formed by the prior breakdown point, and the MA5. You can initiate a short in this zone with a stop loss at 81.20, tied above the daily A1 and the psychological 81 level. The reasoning is mean reversion. In a strong daily sell trend, these intraday pops get crushed fast. Target 1 is 79.05, capturing the retreat to the pivot area, and target 2 is 78.10, just above the S1. This yields about a 1 minute and 2.5 seconds risk reward. Once target 1 is hit, move your stop to break even and trail it manually, because oil can spike on headlines. The setup is invalidated if price closes above 81.08 on the 1H chart. That would show unexpected buying pressure. Now, before I give you the graphic for this one, I want a live pulse check. Type your Brent oil range for tomorrow in the comments right now, low and high. I want to see who's aligned with these levels. Drop it now. Alright, here is the screen plan. The active trader, standard, entry, short 80.50 to 80.80 zone stop loss, 81.20 take profit 1, 79.05 take profit 2, 78.10 risk, reward, 1 to 2.5 hour invalidation, void if 1H candle closes above 81.08. Now strategy 3, the aggressor, high risk, counter-trend acceleration play for the adrenaline junkies. If we get a headline that briefly spikes Brent above 81.08, maybe due to a sudden walkout rumor, wait for a false breakout. Watch the 15-minute chart. Once the price spikes above 81.08 and then reverses back below it within the next 2 candles, that's your entry trigger. Sell short on a 15-minute close below 81.08. Your stop loss is extremely tight. At 81.52, just above the spike high. Target 1 is 79.80, capturing the flush back into the range, and target 2 is 78.50. This offers a risk-reward north of 1:3, but the win rate is lower. This setup is only for those who can lose small and manage risk aggressively. If the spike is violent and doesn't reverse quickly, do not take it. The moment the bounce shows acceptance above 81.08, you walk away. Here is that on-screen plan. The aggressor, high risk, entry, short on 15M close below 81.08 after false breakout stop loss. 81.52 take profit 1, 79.80 take profit 2, 78.50 risk, reward, 1:3.4 hour invalidation, void if 15M candle closes above 81.30 without reversal. Risk management pulse. Never risk more than 1 to 2% per trade. No positions through high-impact news events. An Iran deal headline can drop oil $5 in a heartbeat. Stops are non-negotiable. They are your survival. This is how you stay in the game to trade the next explosive move. Day as we close, the single most critical level for the next session is 81.08. That number defines whether the trap is sprung or the bears lose control. If we hold below it, the path to 77.57 is wide open. If we break and close above it, shorts need to be very careful. Tomorrow's wildcard is the continuation of the Swiss talks and any US inventory data surprise. If a framework agreement is announced, expect a freefall that could test 75.30 in one session. I'll be covering that exact scenario in tomorrow's video. If you want the full breakdown on Bitcoin and the S&P divergence. That video is live now. Tap the end screen. Smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one, right before the move happens.